Hi, I'm Hans Holman, Executive Director of the Collar Institute of Private Equity at London Business School. I'm here at our 2011 Symposium with Thierry Baudon from Europa, the managing partner. We just had a panel on emerging markets and private equity investment. As someone that's been involved in investing in emerging markets for, I think, 30 years plus, I'd just like to hear your perspectives on emerging markets. I guess what has changed since when you first started investing in emerging markets to the current day?
Yes, you're absolutely right. Actually, I started my career in the private sector arm of the World Bank Group almost exactly 30 years ago. And by definition, our role was to invest in emerging markets, which were actually not called emerging markets in those days. And I'm not too sure what emerging markets mean today, to be honest. But let's call them growth markets, for lack of a better word. I think lots of things have changed over the years in those quote-unquote emerging markets. The first thing which has dramatically changed, and I'm obviously stating the obvious, is the fact that the investment flows into emerging markets overwhelmingly come from the private sector. It's maybe hard to believe, but 30 years ago, the World Bank Group alone was accounting for more than half the total net foreign direct investment in emerging markets, or in developing economies, as they were called. So we are now in a situation where even during the crisis, the total amount of foreign direct investment, I'm not talking portfolio flows, I'm talking about long-term investment only, was still about 10-15 times the amount that was going into those economies 30 years ago, only from the public sector through the multilateral banks. So that's the first thing which has dramatically changed. The second thing I would point out as being really a change of major significance is the role of the state in those economies. In my early days, the states or the governments of those countries were obsessed with doing things or impeding things, as opposed to incentivizing private investors, regulating, guiding. And I think this is a major change, which itself is a reflection of the fact that in order to attract private flows, you need to be private sector friendly. 30 years ago, you needed to have, a good government guy who had, good connections to the World Bank and a few other multilateral banks. And most of the money was, effectively channeled, where the government wanted it to go. So the role of the state has dramatically changed. The third thing which has changed, and is maybe less well perceived, is the fact that you now have local institutional investors. It's not just foreign money coming into Latin America or Southeast Asia or China. We do have in my funds Polish investors. So investors investing in their own region through private equity managers. And this again is a reflection of all kinds of structural changes in many of these countries. Pension reform, which has created long-term investing institutions.
Yes.
Life insurance companies. So you have the emergence of local capital markets and local investors. The fourth major change I would point to is the willingness of local entrepreneurs, local corporates, to accommodate foreign investment, which is not necessarily in the form of a takeover by a large multinational. And I think that's why private equity has a great future in those economies, because it's become part of the basic toolkit for local enterprises to grow. The fifth change, which maybe is of a slightly different nature, but again is structurally very significant, is the availability of debt. 30 years ago, again, the World Bank Group or the Asian Development Bank or the Inter-American Development Bank for Latin America were the only providers of long-term debt, because they were able to intermediate AAA-rated paper subscribed by Western investors buying World Bank bonds into long-term money available to those economies at a small premium. And that was it. There was no bank lending beyond short-term lines, and there were no, capital markets, to speak of. And now you have several emerging economies where you have, buoyant domestic capital markets, local long-term borrowing, and that in turn creates, a completely different investment climate. The last thing I would point to in terms of structural shift in a way is the education level of the local populations. When I started Mid Europa 12 years ago now, I would say about 70% of our senior management teams were effectively expatriates. And of course, I realize that Central and Eastern Europe is not exactly an emerging market in a true sense. It's always been part of Europe with a big hiatus during the Soviet occupation years. But in essence, over a 12-year period, we have now shifted to a situation where 90% of our senior management teams are local. And we can see, very, very well-trained, energetic, people coming up the ranks in every one of our companies. And I can, easily imagine that even though I've not worked in Latin America and Asia for quite a while now, that the same thing is happening out there. And therefore, when you have the combination of, a reasonably, friendly environment for investment through the new role of the state, combined with access to debt and capital markets, plus a highly trained workforce, you have all the ingredients for success. So I think the prospects for the so-called growth economies, not to call them emerging markets, are much better today than they were when I started out.
They're great perspectives, Thierry. Thank you.
Thank you.